Good morning and welcome to the bank. And you all know John McDermott very well, the Chief Economist and Assistant Governor. So the Reserve Bank today left the official cash rate unchanged at 1.75%. Global economic growth has increased and become more broad-based over recent months. However, major challenges remain with ongoing surplus capacity and extensive political uncertainty. The level of core inflation has generally remained low. The 5% fall in New Zealand's trade-weighted exchange rate since February is encouraging. If sustained, it will help to balance the growth outlook towards the tradable sector. The growth outlook remains positive, supported by accommodative monetary policy, strong population growth, and high levels of household spending and construction activity. House price inflation has moderated further, especially in Auckland. This partly reflects loan-to-value ratio restrictions and tighter lending conditions. The increase in headline inflation in the March quarter was mainly due to higher petrol and food prices. Non-tradables and wage inflation remain moderate, but are expected to increase gradually. This will bring future headline inflation to the midpoint of the target band over the medium term. Longer-term inflation expectations remained well anchored and around 2%. Developments since the February monetary policy statement on balance are considered to be neutral for the stance of monetary policy. Monetary policy will remain accommodative for a considerable period. Numerous uncertainties remain, and policy may need to adjust accordingly. So thanks very much. Happy to take questions.
I see you're projecting quite a substantial fall in house price inflation over the coming period.
Mm-hmm.
I suppose my question is probably one word, which is really?
It's always difficult, Rob, to forecast house price inflation, as you know, given the supply and demand imbalance that's out there and the very strong migration flows, and also the low interest rates. But we have been encouraged by what we've seen in the last 8 months. I mean, if you take national house price inflation over that 8 months, it's increased by around 1.5%. If you took the 8 months prior to that, house price inflation was running at around 13%. Now, if you look at Auckland, over the last 8 months, house price inflation has actually fallen by about 1.5%. The 8 months before that, it had increased by about 14%. Now, we don't know whether the house price inflation, that the moderation that we've been seeing is going to continue. We think there may be some increase in house price inflation, but nothing like what we've seen in the past. Did you want to add anything, John?
Yeah, it's an interesting question, and one of the things we pondered for quite some time. We are seeing some early signs that there's some moderation, and we'll take that on board. And we're also watching the behaviour of the banks and the credit supply and on the various conditions. But there's also a genuine risk with the incomes, low interest rates, and high population growth that things could continue. So it's something we'll watch very carefully.
You've seen the banks tighten up their credit policies in terms of lending. You've seen an increase in mortgage rates as the banks have had to compete for deposits in order to get their funding. So there are some favourable dynamics out there, if you like, but it remains a significant uncertainty for the forecast.
The other thing I was wondering about, and I know you've had very little time to analyse this, but the impact on the profitability of these banks vis-a-vis their parents across the Tasman, given the measures that were announced by the Australian government, and whether that might provide an incentive for the Aussie banks to lend more or basically get more profit out of here and therefore change their lending practices and try and push things further here?
Yeah, I haven't been thinking much about that, Rob. I'll see if Grant has, but otherwise maybe we can come to it in the financial stability report discussion. But did you want to make any comments, Grant?
Well, we're still really assessing the impact of the tax that was imposed. It's not clear exactly what the imposition would be. It's possible it could be on total global funding, but we don't think it is at this point. We still need to investigate it further.
Yeah. I wasn't quite going to call time, Rob.
The other thing I was wondering about was impact of recent, this is a completely different subject, essentially the fiscal impulse coming from over the road here. We've got a ballpark figure that's been announced so far about what the government's going to spend on infrastructure, which is an increase on what they were signalling previously, and the effect that might be having on your outlook here, if anything.
We built in an extra $1 billion of infrastructure because that's the only policy that we've seen announced at this point in time. So we will wait and see what happens later in the month when the budget's delivered. But we did build in the $1 billion, but recognise that this is, a $250 billion economy.
Governor, I'm just wondering a bit about the inflation outlook. It seems to have been revised lower in the medium term. You have, I think, a low point of 1.1%, which is lower than you had in the previous set of forecasts, and that's despite, unexpectedly strong recent inflation and a big uptick in inflation expectations. So I'm wondering if there's a particular reason for that lower inflation number.
Well, it reflects the fact that you've seen a run-up in oil prices in recent months, and you've also seen a temporary, what we think will be a sharp increase, but perhaps temporary in respect to food prices. And as they drop out of the calculations when you work out an annual rate of inflation, then you will see a lower headline inflation. It's just a matter of arithmetic. But the key story, I think, around these projections is what is the degree of inflation risk that's out there in the economy. And we've thought a great deal about that, as you would expect, and we continue to watch it closely. And some in the market have suggested that inflation pressures are building up quite rapidly. We don't hold that view. We've seen very little impact or very little sign of any acceleration in wage inflation. And the same is true in many countries. I mean, you look around the world at countries that have full employment at this point in time. So you'd look at, say, for example, Japan, Germany, the US, arguably. You're not seeing significant wage inflation coming through in those countries. In fact, some of them are struggling to explain why wage inflation is so low. So we haven't seen an acceleration of wage inflation here. If you look at output growth in the second half of last year, it was weaker than what we were expecting. So that caused us to think about what are the current capacity pressures in the economy and therefore the inflation pressures associated with those. And so we think that there may be a bit less capacity pressure than we thought. If you look at the run-up in headline inflation, which went to 2.2, a lot of that was due to tradables inflation, and most of that was due to the run-up in fuel prices and then the spiking in food prices. So if you look at measures of core inflation, and we look at those pretty closely, they're running at around 1.5 to 2.2. They're in that range. The measure that we put quite a lot of emphasis on, not completely, but we look at it fairly closely, is the factor model calculation, which is at 1.5, and it's been at 1.5 for some time. Then if you look at long-term inflation expectations, they're well anchored at around 2%. Non-tradables inflation is really rising only slightly at this point. And we've seen a significant slowdown in house price inflation. So all of that suggests that we're not going to see a burst of inflation in this economy. But having said that, we're conscious that the TWI has fallen, so that will feed through into some tradables inflation. We are seeing some inflation in the construction sector. It's running at around 8% in Auckland and 6.75% nationally. But, you know, the story, I think, behind these forecasts is that we're not seeing the build-up in inflation pressures that some other commentators are seeing, which is not to say that it won't eventuate. We do expect inflation to move back towards 2% in terms of headline inflation. But that's the main reason why we've kept a neutral stance. We just don't see the need to change that stance at this point.
That was actually my next question. You don't sound like you've moved even an inch towards a tightening bias that as many people had expected. So you're basically saying you're still very much in neutral on monetary policy.
Yeah, we're in neutral on monetary policy, and you know, for the foreseeable future, we would expect the OCR to remain at its current level. Now, bear in mind that the forecasts that we put out are always highly conditional forecasts. And forecasting's always challenging. Inevitably, our forecasts, like everybody else's, turn out to be incorrect in some way. So with these are based on assumptions about growth in the rest of the world, what's going to happen to the exchange rate, commodity prices, migration flows, house price inflation. There's a whole lot of assumptions and judgments built into these. But if the economy develops as the way that we anticipate in these forecasts, or the central set of propositions in this forecast, then we wouldn't see the need to change the OCR in the foreseeable future. Now, if those forecasts turn out to be wrong and they change and the underlying assumptions are incorrect, or there are unexpected developments, then we'll clearly just look at the new information and make a judgment. But let me see, John, did you want to add anything?
Just one point, because it is a very important question. I think we are expecting to see lots of volatility in the inflation numbers in the near term. And we put the details in box D in the document just to explain how we put those numbers together. And it will be difficult to interpret the outturns, but we think underlying inflation is still moving very slowly, as indicated by core inflation.
Can you talk us through your thinking on immigration? It says here that you think the gradual decline in net immigration over the medium term will slow the growth and demand for housing. What is your thinking behind that, particularly with tightening conditions for Kiwis in Australia?
Well, we always get our migration forecasts wrong. The thing that's harder for us to forecast are the inflows. We find in terms of outflows, the relationship between unemployment in Australia and labour market conditions here give us a reasonable degree of insight. But we've had, 205, if you look at working age population since the beginning of this cycle, and it's a large cycle since the beginning of 2012, it's added about 6% to the labour force. I think 204,000 working age population. I think from memory, and Jeannie, please correct me if I'm wrong, we've built in something like about another 130,000 over the cycle. And as I say, we've been underestimating that. So that's clearly a risk for the house price inflation forecast. But did you want to add to that, John?
Well, probably also stress the impact of migration on the New Zealand economy. If you took the last cycle, which we thought was extreme at the time, it was very inflationary. This time around, it seems to be very different. So you not only have to understand the numbers of people coming and going, but actually the composition, the age profile, where they're coming to work, where they're coming for education. And understanding that has been far more important to understanding inflation consequences this time around. And it's been less inflationary.
Governor, what are your, do you still have the same concerns that you had 3 months ago about the global outlook in terms of sort of trade protectionism and the threat that it would have on New Zealand's economy? I mean, are you still thinking that it's fairly heightened like you were then, or what's your sort of view around how things are at now?
I was at a BIS meeting in Tokyo on Monday, and there was still a lot of concern being expressed around US policies, particularly around trade protection, or the uncertainty about, and that's more correct, the uncertainty about where the US may go on trade policy, and also to some extent in respect of tax cuts. Now they seem, the two main priorities at this point for the US administration seem to be trying to get the Obama healthcare policy adjustments through Congress, and particularly through the Senate, and also tax cuts. And I think, I think most commentators recognise that's going to be a pretty difficult issue in terms of congressional approval, either in the House or in the Senate. But the Obamacare reform has gone through the House, as you know, but is now in front of the Senate. So yes, I think a lot of uncertainty around trade protectionism. You've seen the meeting between President Trump and Xi Jinping, which has led to a discussion about the next 100 days and what that might mean in terms of the bilateral trade flows between China and the US. You've seen comments made about Canadian lumber tariffs, and you've seen comments made about renegotiating NAFTA. Those comments still continue to be made. So still a lot of uncertainty there.
So does that still weigh on your view that the global outlook is still hugely uncertain and one of the things that is still, I guess, keeping you awake at night?
Well, I think if you look at what's been happening in output growth in the last 6 months or so, the last couple of quarters, you've seen quite a pickup in the euro area. I think the ECB is forecasting growth in 2017 of about 1.7 or 1.8. That's a big pickup for them. You're seeing stronger growth in China. I think for the annual rate at the end of the March quarter was, I think, 6.9 from memory. You're seeing a slight pickup in Japan. You're seeing it in East Asia and parts of Latin America. So you're seeing stronger output growth. You didn't see it in the US in the first quarter. But in general, if you look at the global economy, you'd say, look, this seems to be on track to something like about 3.5% output growth, which has been the average for the last 2 to 3 decades, based on IMF data. But that output growth has still been supported by some of the most accommodative monetary conditions the world's ever seen. And you're not seeing a lot of inflation pressure building up in these economies, and certainly not in Europe, not in Japan. Core inflation in China, the governor mentioned the other day, was 1%, even though producer price inflation is running much faster than that.
Just at that meeting, how did you view other governors' views on their accommodative stance? And did you get a fair sense, do you think, of where they're headed? Is it all tightening from here? Did you come away thinking?
Well, I think I can't comment on what's happening in the meeting, but if I look at the public statements that have been made in recent weeks, including by Mario Draghi overnight. You're seeing the US indicating that there's perhaps another 2 interest rate rises this year. I think the market's building in something like a 90% probability for June. You've seen Mario Draghi say that he expects quantitative easing to continue throughout the rest of the year at the rate, I think, of 60 million euros a month, 60 billion euros a month. Government Kuroda has expressed commitments to targeting the 10-year bond yield. So I'd say from the public statements that have been made, you don't see any announcement by either the ECB or the Bank of Japan about any tightening of policy at this point in time.
Governor, could you talk about where you think full employment is in this economy?
There'll be various views on that, and I'm sure there's many in this room. I'll get John to give his thoughts. From some of the work that we've done, it suggests it could be around 4.5% or thereabouts, but let me see if John's got better research than I do.
So you focused specifically on the labour market question when you asked about full employment, which is not the way we normally assess work capacity. Is we try to take the entire economy, not just the labour market. So our framework is to talk about potential output and the output gap, and we think we're reasonably close. And that means there'll be some pressures in some parts of the economy, but less in others. So just to remind you, we talk about more the goods market rather than labour market when we're trying to assess overall capacity. And in part, that's because of New Zealand's history with labour market data. There was a long period of very high and underutilised labour, and it trended down over a long period of time. So when you try to estimate sort of a typical level of unemployment that's non-inflationary, basically you can't identify it in New Zealand. It's almost impossible. So as the Reserve Bank, like anybody else, if you're trying to get an estimate of the Nauru, is basically guessing. You can't come up with very good estimates.
What our forecasts show, which, as I say again, are highly conditional projections, we have the unemployment rate falling to around 4.5% and inflation rising to around 2%.
So Treasury has a crack at measuring the Nauru, which is quite a bit lower than where unemployment is at the moment. Could you argue that we're not at full employment, and that's why wage inflation is so low, and that therefore monetary policy needs to be even easier to try and soak up that spare capacity?
The lags between... So the labour market is almost the slowest indicator to move. By time you've got it right on wage information, everything else in this economy has moved. So if you wait to find out what's going on with that indicator, you're almost too late with monetary policy. Now, if you look at the information, we've got a range of indicators in here. There's a new measure that's got the name of Lucy that shows you that there's been increasing absorption of labour market resources. And when you put that together with all our other indicators, we think, sort of capacities are just about used up. But we'll also admit there's a range of estimates, and that range is quite large.
Governor, could you explain why then we're seeing such low wage inflation, do you think?
Well, part of it's what's happened to the supply curve. I mean, you've seen the labour supply increase by 6%, as I mentioned, through the migration flows since the beginning of 2012. So that's a big rightward shift in the labour supply curve, and that will lead to some moderation in wage pressures you would expect for any given level of demand. The sorts of issues that get raised in discussions about this in global fora basically talk about sometimes composition effects. So a lot of the employment growth in many countries is in the services sector. Now, they may be lower paying jobs, but not always, far from it. The services sector is becoming increasingly considered to be a tradable sector rather than non-tradables. So that's also affecting wage outcomes, particularly the effects of globalisation there. And you also hear comments about trade-offs being made in terms of job security and wage moderation. So they are the sorts of comments you'll hear in discussion overseas. But let me see if John wants to add anything.
Yeah, the other things, Bernard, you need to look at is labour productivity. So
Yep.
wages adjusted for inflation over the long term tend to be very closely correlated with productivity. Productivity has been low, not in New Zealand and globally, and because inflation and inflation expectations has been very low, it makes it very difficult when you go into the negotiating table to actually claim for more than inflation or more than inflation. So people's expectations have been moderated.
Yeah, they're
well.
good points.
Governor, the IMF came out a couple of days ago and said it would like to see some of the tax incentives for property investment reduced by the government. What's your view on that?
Well, we've commented before about the supply-demand imbalance in the housing market. We see the sorts of demand-side drivers there with migration and low interest rates. But you also see the supply side that's affected by many things, including productivity in the building sector, in terms of land availability, in terms of regulation, in terms of tax policy. And we've talked about negative gearing and the impact that has on inflating house prices.
So would you like to see some measures to address negative gearing?
Well, I think they are the sorts of things that any government that's in office would want to take a look at. What are the sorts of regulatory distortions that could lead to house price inflation?
Also, the IMF recommended that the Reserve Bank look again at its open bank resolution system, and in particular suggested exempting bank accounts with less than $10,000 in them from the OBR scheme. What's your view on this? I know it's not directly related to monetary policy.
Yeah, I'll probably leave that to the FSR. Happy to cover it then.
You did mention just in your comments on house prices that banks could become more cautious in their mortgage lending. Are you seeing this at all?
We've seen more caution in lending to developers, I think. Not from the conversations we have with banks, not developers that come with very solid proposals, but some of the more less familiar developers, if I could put it in a very clumsy way, that have come with proposals that the banks are thinking pretty carefully about whether they want to finance or not.
Not residential mortgages, though?
I think they're talking mainly about commercial development and residential development, but less so, I think, on mortgage lending, although you have seen private sector credit growth slow a bit. I mean, it was running at around 8%. I think it's just under 7% at the moment. And they have cut back. They have cut back the lending in respect of investors. I should certainly comment that. and I had some data. Yes, I'll just read it to you. This is the value of new loan commitments. March data over the year before were down 9%. The drop in terms of property investors was down 21%, and the others, non-property investors, was flat.
Governor, you mentioned that the housing market was moderating and that was something you were watching. You said previously that even if you had a debt-to-income multiple cap, you wouldn't be using it. Is that still your view, or in fact is it an even stronger view given what's happened in the last couple of months?
No, it's still our view that if we had that in the macroprudential toolkit, that we wouldn't use it at this point in time. Now, we expect to be going out with a consultative document in the next 2 to 4 weeks about debt-to-income ratios as a macroprudential tool.
Just to clarify, because the government asked for a cost-benefit analysis first and then a consultation with the banks. Is this the consultation with the banks?
Yeah, what the government asked us to do was, in the consultative document, to prepare a cost-benefit analysis. And we've largely completed that consultative draft. We've been discussing it with Treasury. We'll give it to the Minister. He'll look at it for a couple of weeks and then we'll put it out.
But that's just the consultative document on the cost-benefit analysis. There would have to be a second round of consultation on the actual tool itself. Was that correct?
No, this is...
Yeah, so this is a consultation document, including a cost-benefit analysis to look at the proposal to put it in the toolkit. So then if an actual policy initiative was being proposed with specific shape and parameters around it, then that would be a further consultation.
Right.
So given that, it would be pretty unlikely you'd be in a position to actually apply it, given you're going to need 2 rounds of consultation until well into next year. Is that correct?
Well, if it was going to be used, it would be some way off. I wouldn't put an exact time frame on it, but yeah, not in the near term.
It would certainly require the two-stage process.
Just one more from me. In the opening statement, you've taken out some of the lines about uncertainties overseas. What are the key risks that you are focused on internationally that could shift the outlook?
Well, I think it's the biggest uncertainties in my mind. If you put outside the political risks, if you like, in terms of what might be happening in the Korean Peninsula and what might be happening in Syria and elsewhere, then the main focus, I think, is what the US policy is going to be. You've got an economy probably growing at around 2% or thereabouts, close to what the Fed believe is potential output growth. And the Fed believe is at or close to full employment. And so the question will be, what sort of fiscal adjustment do you see in the US, either through tax cuts or infrastructure spending or both? There's uncertainty, as we talked about before, around trade policy. And I think the other biggest uncertainty is around the build-up of debt in the Chinese economy. And you've seen the PBOC recently tighten credit conditions in China.
Governor, irrespective of the OCR, do you have, could you have a stab at what interest rates are doing out in the real world in terms of what customers are seeing and where this might go over the next 6 or 12 months?
No, I wouldn't speculate on that. All I can say is that, as I'm repeating myself, for the foreseeable future, we see the OCR on the track that we've talked about. What we are seeing is that banks have, some of them are approaching their limits in terms of offshore wholesale borrowing. They're able to access that pretty easily You've seen the cost of that financing rise over the last 6 months or so, but they can still access it reasonably easily, but they are getting up against some of the banks against their limits. So that means they need to look at the domestic market for their financing, and that's leading to an increase in competition for deposits, and we're seeing an increase in deposit rates. So the banks essentially have been faced with higher costs of funding, and that's been reflected in the adjustment or the increase in mortgage rates that we've been seeing so far. And I would expect that competition for deposits, to continue quite significantly in coming months.
So what are those limits? Because under the core funding ratio, they can use long-term wholesale markets and domestic term deposit markets. So what would be? I can understand the short-term wholesale; they'd be limited in there, but why are they limited on wholesale long-term?
Oh, I think it's just in terms of their treasury policies.
So are you saying you expect the competition for deposits to intensify if they have to look for a greater proportion from domestic sources?
Well, certainly to continue, yes.
Governor, the government's obviously looking at formalising the Governors' Committee that you established to set monetary policy, and Labor also has a sort of a similar plan. Do you think it's time for the RBNZ to move away from the single decision-maker model?
Well, I think in many respects we already have. Decision-making around monetary policy has always been based on committees in the bank. So, for example, we've got a monetary policy committee of 12 people, which includes 2 outsiders, and we've had 2 outsiders since 2001 when the Svensson came and did an assessment of our governance framework. Now, when I became governor, I set up a governing committee, which comprises the 4 governors to make the major financial and economic policy decisions that the bank needs to make. Now, that was a model that was copied off the Bank of Canada. They have a governance or a governing council. So that was the framework that I wanted. And so the monetary policy decisions that the bank makes are made by this governing committee comprising the 4 governors. They're based on advice that we receive from the broader monetary policy committee of 12 people, which, as I say, includes 2 outsiders. And the decision-making doesn't involve voting or anything like that. It involves consensus decision-making. So that's the way we run monetary policy in terms of decision-making. So it is committee-based. It's not a single individual coming out and saying, this is what I'm going to do, and ignore the advice of other people around them. There's so much strength in the institution in terms of experience and judgment in these matters that I felt it sensible to go to such a framework.
But there's no transparency around that framework at the moment, is there? I mean, if it was formalised in some way, surely there would be more transparency around that decision-making process.
Well, if you look around the world, there's lots of monetary policy committees like we have here in terms of the governing committee, where decisions are made by internal committees. There's a mixture. Sometimes you see outsiders on those committees, but in many countries they're made by internal colleagues within the institution. And that's because this is regarded as a full-time occupation, monetary policy. It's not something you sort of drop in and make a quick decision and think that you've done monetary policy. And, that's the way we've run it. In terms of transparency, the bank's regarded amongst the most transparent central banks in the world. A recent survey across the world's indicated that the RBNZ was the second most transparent central bank in the world. We provide enormous amounts of data in terms of the monetary policy statement. We're one of the very few central banks that puts out interest rate projections. We've done that for many years. All our assumptions are laid out. These press conferences, we try not to avoid questions. We try to be pretty open. So I don't think there's an issue around transparency of what the bank's saying. Hopefully not. Well, thanks very much indeed.